In the world of finance, two common yet fundamentally different approaches to building money are short-term investing and long-term wealth creation. Although both involve the goal of growing your financial portfolio, the strategies, risks, mindsets, and outcomes involved vary significantly. Short-term investing often focuses on rapid gains within months or a few years, driven by market timing, volatility, and immediate results. Long-term wealth creation, on the other hand, is rooted in patience, consistency, and strategic planning designed to provide financial independence, generational wealth, and true freedom. Understanding the differences between short-term investing and long-term wealth creation can help individuals align their financial activities with their ultimate goals. Let's break down the top 10 key differences that separate these two powerful, yet distinct, paths to financial success. 1. Time horizon. The most obvious and defining difference is the time horizon involved. Short-term investing typically refers to strategies meant to yield returns within a few months to up to 3 years, often including day trading, swing trading, or buying into volatile assets for quick exits. Long-term wealth creation, however, spans decades, with a focus on slow, compounded growth through methods like retirement investing, real estate holdings, and business ownership. This difference in time frames influences every decision you make, from what assets to choose to how much risk you can take. 2. Mindset and patience. Short-term investors are often driven by immediate results and quick decision-making. They need a reactive mindset and the ability to pivot quickly with market conditions. Long-term wealth builders cultivate patience, discipline, and foresight. They understand that compounding takes time and that sticking with a sound plan, even through downturns, is often more profitable. While short-term investing can satisfy the urge for action, long-term wealth creation requires a mindset shift to delayed gratification and resilience. 3. Risk tolerance and volatility. Short-term investing tends to involve higher risk and volatility. This includes reacting to market swings, economic news, or earnings reports, which can dramatically impact stock prices overnight. Long-term wealth creation involves mitigating risks by diversifying and holding investments that historically grow over time, such as index funds or real estate. While both strategies involve risk, short-term investing exposes you more frequently to market noise, while long-term strategies buffer these risks through time and compounding. 4. Use of leverage and speculation. Short-term strategies often rely on leverage, using borrowed money or margin, to amplify gains. This increases the potential for both profit and loss. It's not uncommon for traders to speculate on options or penny stocks hoping for a quick windfall. In contrast, long-term wealth creation is typically grounded in fundamentals and value, avoiding speculation in favor of measured, strategic growth. This includes consistent contributions to 401ks, buying rental property, or investing in dividend-yielding companies that show strong track records. 5. Tax implications. There's a significant difference in how gains are taxed between short and long-term strategies. Short-term capital gains, for investments held under a year, are taxed at ordinary income rates, which can be as high as 37% in the U.S. Long-term capital gains, for investments held over a year, enjoy preferential tax treatment, with rates of 0%, 15%, or 20% depending on income. This difference alone can dramatically affect your net returns and should be a major consideration when deciding between these two paths. 6. Time commitment and active involvement. Short-term investing demands constant attention, research, and quick reactions to market developments. It's almost a part-time job and can be stressful for those not equipped to handle emotional ups and downs. Long-term wealth creation, in contrast, emphasizes automation and consistency. Investors can set and forget their portfolios through auto-investing, rebalancing annually, and trusting in long-term market trends. It's more passive, less time-consuming, and better suited to people with busy lives and lower financial expertise. 7. Impact on lifestyle and stress. The emotional toll of short-term investing is often underestimated. Daily market fluctuations can lead to anxiety, impulsive decisions, and burnout, especially if you're watching your portfolio every hour. In contrast, long-term investors tend to enjoy peace of mind, knowing that their plan doesn't hinge on day-to-day performance. Their lifestyle tends to remain stable because their strategy isn't reactive. This mental and emotional difference is critical, especially when investing for major life goals like retirement, education, or legacy planning. 8. Investment vehicles and strategies. Short-term investors often focus on stocks, options, crypto, or forex, seeking opportunities in assets with high volatility and liquidity. Their strategies include technical analysis, chart patterns, and speculative trades. Long-term investors prefer mutual funds, ETFs, real estate, retirement accounts, or annuities, relying more on fundamental analysis and diversification. Their strategy includes compounding dividends, dollar-cost averaging, and long-hold appreciation, all focused on stability rather than speed. 9. Role of compounding. The power of compounding is a key differentiator in long-term wealth creation. Compounding interest and dividends over decades is what turns modest savings into millions. Short-term investing doesn't allow compounding to work as effectively because assets are often bought and sold rapidly, leaving little time for reinvestment growth. Compounding rewards patience, and those who embrace it can build exponential wealth over time, something that simply can't be matched by short-term trading. 10. End goal and financial philosophy. Finally, the ultimate objective separates these two approaches. Short-term investors are often focused on profiting quickly, building income or flipping capital. It may be suitable for achieving near-term financial goals, such as buying a car or funding a vacation. Long-term wealth creation, however, is about financial independence, legacy, and security, creating a lifestyle that isn't dependent on employment or market performance. It's a philosophy of building enduring value, not just immediate gains. Short-term investing and long-term wealth creation each have their place in a well-rounded financial strategy, but they serve fundamentally different purposes and require different mindsets. Short-term investing appeals to those seeking fast results and can be rewarding for the skilled and disciplined. However, it carries high risks, demands constant involvement, and can lead to emotional fatigue. Long-term wealth creation, on the other hand, is about building a stable, enduring financial future through patience, consistency, and sound strategy. It may not offer the thrill of a quick profit, but it delivers the kind of freedom and security that most people ultimately desire. By understanding these key differences, you can tailor your approach to fit your personal goals, risk tolerance, and vision for the future. Whether you focus on one method or blend the two, the most important factor is clarity, knowing what you're aiming for and staying the course with intention and discipline.